Well, every time the Fed has raised rates, a sell-off ensues on Wall Street. This time, however, the market's reaction has been relatively muted. Karina Huber has more.
News that the Federal Reserve would raise rates for the first time in 2016 sent U.S. stocks lower. The Dow Jones Industrial Average fell 118 points. The S&P 500 closed 0.8% lower, and the tech-heavy Nasdaq was down 0.5%. Yields on the two-year Treasury, the most sensitive to Fed decisions, hit 1.25%, its highest level in 7 years. The dollar also gained. The rate hike was widely expected, but the Fed's outlook for 3 rate hikes in 2017 was more than expected. Nevertheless, traders at the New York Stock Exchange say investors have gotten used to the idea that rates are on an upward trajectory.
We can't keep rates at zero or close to zero forever. We all know that. I think many people took advantage of that in a beneficial way, but now we have to get back to the new norm, whatever that is.
This marks just the second time in a decade that the Federal Reserve has raised interest rates. Loose monetary policy has been very good for the U.S. markets. The S&P 500 has rallied about 200% since hitting a low in March of 2009, right after the financial crisis.
For much of that time, rates have hovered at or near zero. Rate hikes may be a headwind for the markets, but traders say the tax cuts and infrastructure spending that President-elect Donald Trump is promising are a tailwind for the market.
Everyone's waiting for this market to roll over, but I think right now people are optimistic, businesses are optimistic, and that's the most important thing because they're going to provide the most jobs and for the money for Main Street.
The period of loose monetary policy may be on its way out, but expansive fiscal policy appears to be on its way in, and that could help the markets continue their rally, so long as inflation doesn't get out of control. Karina Huber, New York.